Good evening, everybody. Sorry for the delay, the normal Webinado technical difficulties. So I'm going to do this quick. We've got the great pleasure of having Simon Rhee with us tonight. He's the author of the bestseller, The Tao of Trading, How to Build Abundant Wealth in Any Market Condition. So not going to delay any longer. Welcome, Simon. We're anxious to see your information tonight.
Thanks very much, Steve. Thanks for having me, and it's a real pleasure to be here. Welcome, everybody. What I want to talk to you today is about, are we in a bear market rally or a new bull market? Obviously, we've had a lot of people, a lot of commentators heralding the arrival of a new bull market a couple of weeks ago, with the S&P having rallied 20% from its low. So let's dive into all of that. Let's look at some of the evidence and see what some of the implications are going to be for all of us in the coming months and years as we trade and invest our way through these markets. So this class will be for you if you are a wage or salary earner without a strategy to grow your income more quickly than inflation. You're going to really get a lot out of this class if you're concerned about current market volatility, the potential for a recession and further declines in the stock market. If you want to accelerate your wealth creation potential by generating recession-proof new income. If you're stuck in a job answerable to a boss and looking for ways to become your own boss, or if you're wanting to learn how to profit from trading so you can retire sooner or richer or both. Really, I'm just passionate about helping people develop multiple income streams. Warren Buffett says it best, if your salary is your only source of income, you're only one step away from poverty. As you all know, trading is risky. Everything that we discuss today is for educational purposes only. There is no investment or trading advice being given, just as long as we're all clear on that. A little bit about me. I've got a Bachelor of Economics degree. I've also got a graduate diploma in applied finance, and I've worked as a financial markets professional since 1992. I have experienced firsthand the highs of big wins as well as the worry and confusion and pain of financial loss. So if you've been through any of that, I know exactly how you feel. I left the banking industry in 2017, and my vision now is to help people live more creative, joyful and inspired lives by alleviating the burden of financial stress that weighs so many of us down. And my mission is to revolutionize the way finance is taught by shattering long-held Wall Street myths. And I've helped thousands of traders become more profitable in the markets since 2017. I worked at Goldman Sachs for 14 years, and between 2005 and 2010, I founded and headed up the markets desk in Sydney. I worked at Citibank in Singapore for 6 years between 2010 and 2016, and here I consulted to and worked with some of the wealthiest individuals and mutual funds and billionaires across Asia and Australia. I'm also the author of The Tao of Trading, How to Build Abundant Wealth in Any Market Condition, that made Amazon #1 bestseller in 5 different categories. So the key learning outcomes for today's training, let's talk about where are we now, bull market, bear market, recession. What are the key factors to focus on that will keep you on the right side of the market, the key differences between trading a bull market versus a bear market, and how to make a living from the markets, why try to making a killing trips people up, and how to accelerate your wealth creation potential. So let's start off with talking about where are we now. Let's look at some definitions first of all. What is a bull market? This is just taken from Investopedia. A bull market is a period of time in financial markets where the price of an asset or security rises continuously. The commonly accepted definition of a bull market is when stock prices rise by 20% after 2 declines of 20% each. Traders employ a variety of strategies such as increased buy and hold retracement to profit off bull markets. Like I said, this is just taken directly from Investopedia. I haven't made any of this up. What is a bear market? Again, let's go to Investopedia. They say bear markets occur when prices in market decline by more than 20%, often accompanied by negative investor sentiment and declining economic prospects. Bear markets can be cyclical or longer term. The former lasts for several weeks or a couple of months, and the latter can last for several years or even decades. Short selling, put options, inverse ETFs are some of the ways in which investors can make money during bear markets. What is a recession? Well, in 1974, economist Julius Shiskin gave us 2 quarters of declining GDP as a rule of thumb to define a recession. And this has been the generally accepted definition since then. And in fact, 10 of the last 10 times where we've had 2 consecutive quarters of declining growth, it was declared an official recession by the NBER We've had a lot of people trying to explain away the fact that we're not in a recession despite having 2 consecutive quarters of declining growth this year. You know, what I'm going to encourage you to do is not focus so much on official definitions, focus more on what's happening. But let's look at the case for the bulls first of all. The first the first argument in the bulls' favour is investor sentiment is dreadful. We had 19 straight weeks of bears exceeding bulls on the AAII investor sentiment survey. And the fact that investors remain bearish on the stock market is actually bullish for forward stock market returns on nearly all historical measures. The spread between bulls versus bears in the AAII sentiment survey has been negative for 19 consecutive weeks. That's the 3rd longest streak since this survey's inception in the late 1980s. And returns going out 6 to 12 months after sentiment gets this bearish tend to be strongly positive. All right. So if everybody's bearish, generally it means everybody's already sold, and he's already sold, the market will generally stop falling, and as the market starts to rise, it will tempt new buyers into the market, which, you know, is how trends form. The one chink in this argument today, I think a lot of people have been feeling bearish but acting bullish. You know, if you ask them, they don't feel good about the economy, they don't feel good about the stock market, but they're still fully invested, and that's sort of been a feature of the post-QE world that we've been in. Earnings. The market entered second quarter earnings season with very low expectations, with estimates having been slashed in recent months. The negative expectation has left room for positive surprises versus expectations, and beat rates for revenues and earnings have been well above average. The other pro is the election cycle. We are in year 2 of the presidential election cycle, which is the midterm year. That has easily been the worst of the 4-year cycle since 1928. However, the S&P 500 has typically bottomed late in the 3rd quarter of these midterm years and seen strong gains in Q4. So if you follow the election cycle pattern, the stock market should be due to bottom in the next couple of weeks. Year 3, which is next year, has been the most reliably bullish year in the election cycle, with the S&P posting gains 82.6% of the time. And we've got an improving, we appear to have an improving geopolitical situation. It appears Ukraine's counteroffensive in the Donbass region has been an unexpected success. We've got oil trading back at 9-month lows. The China-Taiwan saber rattling appears to have settled down for now. And all of these kind of geopolitical concerns, look, they're still there, but they appear to be improving rather than getting worse. Now let's talk about the case for the bears. First and most importantly is don't fight the Fed. The Fed has been unambiguous in its goal of reducing aggregate demand. To try and tame inflation, the Fed is hiking rates at the fastest pace in more than 4 decades. The thing is, the economy is far more sensitive to interest rate changes now than 40 years ago, owing to the fact that there is significantly higher public and private debt load. Back in 1981, total debt to GDP was 155%. As at the start of this year, it was 349%. So rising rates will have much more of a crimp on the economy. Economic and financial markets pain, though, are policy objectives, not undesirable byproducts. Okay, the Fed wants to get unemployment higher. And if you look at 10 of the last 13 hiking cycles, 10 of them resulted in hard landings, and every time we had high inflation, it resulted in a hard landing. The only times we had a soft landing, where these 3 green arrows that are shown, is when inflation was below 4%, which is not the case today. We turn to the real bond king, Lacey Hunt. He says monetary restraint has resulted in recessions in all but 10% of the cases since the Fed's founding in 1913. So if history is any guide, the Fed is more than likely to plunge us into recession given the tightening path that they're on. Now, the Fed balance sheet versus the S&P 500, we all know the Fed has started tapering their balance sheet, but there's a strong correlation between the size of the Fed balance sheet and the S&P 500. And we know from prior episodes where the Fed has tried to taper, back here, the S&P 500 didn't like it, became very, very volatile. The Fed is tightening into an economic slowdown, all right? And this by itself places us into a very different economic environment from anything we've seen before. The Fed usually tightens into an economy that's overheating, not into an economy that is arguably already in recession. We're potentially in a wage price spiral. We're not seeing any wage moderation in the data, only wage acceleration. The August jobs report gives US corporates carte blanche to raise prices as much as they like to offset rising input costs. And the San Francisco Fed released a paper last month saying, given the large increases in short-term inflation expectations in the past year, our results point to an important upside risk to inflation as workers demand higher wages that businesses could pass on to consumers by raising prices. Everyone's feeling the pinch from inflation, right? We talk about it at the dinner table, we talk about it in the supermarket queue, and the labour markets are very, very tight, with job openings exceeding number of people available to fill the jobs by a record number. So workers, for the first time in a long time, have got a bit of bargaining power. They can say to their bosses, hey, I need more money to help me out with this inflation we're seeing. And given how difficult it is to fill jobs at the moment, bosses will say, yeah, you know what, we'll give you a pay rise because we can pass it on easily through higher prices in the products we sell because everyone's got a job. This is how wage price spirals start. So the only way out is likely to be a deep recession that sees demand destruction as a result of spiking unemployment. Also, if we look at the performance of bear markets, the S&P made its recent bear market low on the 17th of June with a drawdown of 23.6%. Now, the average drawdown in all bear markets since 1929 is 36%, and the average drawdown is 42% if we're in a recession. So if this bear market is indeed over, it would be both shorter and less extreme than average. Long-term technicals. The S&P 500 remains in a long-term downtrend. It was recently rejected at this trend line and the 200-day simple moving average. And we saw a strong down move, obviously, on Tuesday post the CPI. That move was on high volume, the CPI coming in hotter than expected. Leading indicators are all starting to roll over as well. The US composite PMI fell to just 45. Services PMI is down to 44.1. Whenever these readings are below 50, that's signaling contraction, and they are very good leading indicators of recession. The Empire Manufacturing Index last month printed at minus 31.3 versus expectations of 5, second lowest print on record. Housing is also starting to roll over. Both new and existing home sales are in free fall with inventory soaring. New home sales are down over 50% from their 2020 peak, and the inventory of new homes for sale rose to its highest since April 2008. Housing's contribution to GDP has also been crushed, and in fact housing has gone from a contributor to GDP to a subtractor. The NAHB Housing Market Index fell for the 8th straight month to 49. That's the lowest since May 2020. Also, dollar strength. The US dollar wrecking ball is in full play. Strong commodity prices have helped send the US terms of trade to record levels, and the dollar has actually underperformed the move implied by the terms of trade index. You can see this pale blue line, which is the terms of trade index, and the dollar, which is the dark blue line, tend to track each other fairly closely, and a big gap has opened up here, which argues for potentially even more dollar upside. And the strong dollar is generally consistent with weak risky asset performance. And you can see here, whenever the dollar has a year-on-year change of more than 15%, something breaks. Whether it was the LBO crisis, the Mexican peso crisis, the Russian ruble crisis, the dot-com crisis, the housing crisis, the global financial crisis, the pig's debt crisis, you can see whenever the dollar has had this sort of year-on-year change, something is broken. Yield curve remains deeply inverted. This is directly from research by JP Morgan. They say the yield curve has inverted, which is 10-year yields less than 2-year yields, ahead of every recession in the past 40 years. So yield curve is certainly giving us a warning sign. And you can see that inversions in the yield curve tend to precede black type swan events as well. This inversion preceded the savings and loan crisis. This one preceded the Russian bond crisis and the long-term capital management collapse. This one preceded the tech wreck. This one preceded the global financial crisis. This one preceded the COVID pandemic. And this one is preceding, well, we don't know yet, but it's certainly sending us a warning signal. Bear in mind also that even despite the fall we've seen in stock prices, long-term valuations are still not cheap. It's still about 14% above the recent 20-year average using its cyclically adjusted PE ratios. And if you look at the starting point, we've got on a cyclically adjusted PE of about 30, which implies returns of about 1.5% per year over the next 15 years for the S&P 500. So very lean returns. So the case for the bulls, we got bearish investor sentiment, we got earnings which are holding up okay, we got seasonality in the election cycle, we got an improving geopolitical situation. The case for the bears, don't fight the Fed, wage price spiral, bear market performance, long-term technicals are bearish, leading indicators are rolling over, housing is rolling over, dollar strength, yield curve, and valuations are all looking negative. So you can put me in the argument of I think we're still in a bear market, not a new bull market. Now, bear in mind, between 1969 and 1979, which is probably the most similar economic situation to what we're in now, the S&P did nothing for 10 years. Let me ask you, have you got a strategy that is going to enable you to thrive if we go through another 10 years like this? But as I said earlier, don't worry so much about official definitions. Focus on what's going on. Focus on the prevailing dominant trend. And the 200-day simple moving average can provide important clues about market behavior. I love this quote from Paul Tudor Jones. My metric for everything I look at is the 200-day moving average of closing prices. I've seen too many things go to zero, stocks and commodities. The whole trick in investing is how do I keep from losing everything? If you use the 200-day moving average rule, then you get out, you play defense, and you get out. Point being, if guys like Paul Tudor Jones are looking at the 200-day moving average, I should be, you should be, we all should be as well. So what are some key mistakes to avoid in this sort of environment? Well, I think number one is listening to your gut and the news and the crowd in response to headlines. And let me give you an example of this. So I put this tweet out. This is back on the 13th of July, and I just made the comment that everybody is de-risked ahead of CPI. It's going to be fun watching the stock market rip on a hotter than expected CPI. This is when we had the 9.1% CPI reading. I got ripped to shreds in the comments on this tweet. I got people saying, well, you worked at 14 years at Goldman and you're this stupid and you don't know what you're talking about and you're an idiot. And when people rip me to shreds on Twitter, that's when I know I'm onto something. And this is what happened. All right, the S&P rallied almost in a straight line, 14% from that CPI print. All right, but if you get caught up in general sentiment and what everybody thinks and what everybody knows is going to happen, very often it will send you in the wrong direction. The other thing to worry about is chasing moves. Now, unfortunately, I can't share my screen with you, but the thing to be aware of is in this sort of environment, it does pay to buy puts on those rallies. And what tends to happen is you get a rally, and that's when Jim Cramer gets up on CNBC and starts talking about a new bull market, and Tom Lee says, hey, you should buy equities. And usually people are only brave enough to buy stocks after they've had a strong rally. But I'll give you a rule of thumb. If the S&P or a stock you're watching gets to 3 average true ranges above its mean, the 21 EMA, you want to be selling, or you want to be selling call credit spreads, or you want to be buying puts. Don't chase the move higher. So how do we stay on the right side of the market? Well, the 200 SMA can be a really powerful clue. It's widely viewed as the line in the sand between a bull market and a bear market. It's the dividing line between a long-term uptrend and a long-term downtrend, and it gets a lot of attention. Basically, everybody is looking at it and is aware of it. Markets that are trading at their 200-day moving average are generally slower by every kind of dip kind of markets. However, when the market is trading below its 200-day moving average, they tend to be faster. They've got a faster, scarier feel to them. We've seen that in 2022. The news headlines generally suck. CNBC is running markets in turmoil segments. Everybody's convinced markets can only go lower. Bear market rallies, though, can be ferocious and big enough to convince almost everybody that the bear market is over. Markets are easiest to trade when they're happy or bored, and a market that is below its 200 SMA is neither of those things, and that's when you really need to know what you're doing. Here's an example. This is the NASDAQ. You can see when it's above its 200-day moving average, the pullbacks all tend to be quite small, and it's a fairly well-behaved market. Yeah, we had a COVID crash here, but that was very short-lived. But as soon as we get below the 200-day moving average, the swings start getting bigger and there's just more violence in general. This is the S&P during the global financial crisis. And again, when we're above the 200-day, it's small little moves. It's pretty well behaved. Yeah, we get a couple of little scares here, but you know, up, yeah, pull back. But it's a fairly well behaved market. Volatility starts to pick up and we break the 200-day, and then once the dam breaks, you know, it's like all hell breaks loose, and the moves become much, much bigger and much scarier. So 4 buy the dip indicators that have stood the test of time. You buy when the yield curve is not inverted, when earnings are still growing, when the economy is still expanding, and when credit spreads are not expanding. If all 4 of these factors are, and there should be a tick in there, markets have always reverted to their uptrend after a sell-off and gone on to make new all-time highs. Well, at the moment, the yield curve is not inverted. Earnings are still growing, just. The economy is no longer expanding. We have had 2 consecutive quarters of negative growth, and credit spreads have been widening all year. So only 3 of these 4 factors are present, which means we're not in a buy the dip kind of market. We're in a sell the rally kind of market. So let's look at the key differences between trading a bull market and trading a bear market. Trading a bull versus trading a bear. The most obvious difference is that during a bull market, stock prices trend higher. During a bear, stocks trend lower. So to thrive in a bear market, you need to learn how to profit from falling stock prices. This is in itself is a jarring reality for most who are conditioned to believe stocks only go up. This is a Google Trends search analysis of search terms why did stocks rise, which is this blue line on the bottom, versus why do stocks drop, which is this red line. Stocks are rising, nobody's the least bit curious. Stocks drop, everyone wants to know why. Bear markets have a different character. So as you saw earlier, when stocks trade below their 200 daily moving average, they undergo a personality shift. They become more volatile, they change direction more quickly and more frequently. It's almost like a Dr. Jekyll and Mr. Hyde kind of switch, and counter trend moves can be dramatic in a bear market. You know, in a bull market, you can pretty much ignore these pullbacks. You don't need to trade, you don't need to position yourself short for moves that are 3, 4, 5%. This was 2021. Now this was the NASDAQ during the tech wreck. The NASDAQ over this period declined 83%, but during this time there were 7 bear market rallies of between 24% and 59%. Imagine trying to thrive in this environment without knowing how to identify trends and make money in both rising and falling market conditions. Imagine this, right? You got a rally of 59%. All right, everybody was convinced the worst was over, and yet the NASDAQ still went on to make new lows. S&P 500, like I said, between 69 and 79, that was a lost decade. Now, have you got a strategy in place for a decade like this? Between 2000 and 2013 as well, the S&P made no progress. It started high and it finished high, but it did nothing for 13 years. This slide didn't come up properly, but yeah, there have been 30-year periods where we've had negligible real returns for the stock market, and this is what the just by now crowd never likes to tell you. Now, trend following is, I'm a big believer in trend following. I'm a trend follower at heart, and trend following is relatively easy to find and manage trades in an environment like this, where the pullbacks are pretty polite. Yeah, I mean, you usually get one squirrely pullback a year, but that's about it. But in an environment like this, you need to learn how to trade counter-trend trades as well. All right, if you're looking just for trend setups like this, you're going to be late to the trade. There's not going to be many setups available, and you're probably going to be getting in just as the market turns around again. So you've got to combine trend following and counter-trend trading techniques. Here's some examples of some bearish setups we took in SMH, where we're buying puts here, and we cover here. And we're buying puts here, and we cover here. All right, so we're taking advantage of bearish trades, but exact same chart, we're also taking advantage of bullish trades. And we're doing that by just taking advantage of market turns, identifying where a market turn becomes a high probability and taking advantage of it. Here's an example of a bearish setup I took recently in the triple Qs, the NASDAQ ETF. So I bought a put debit spread on the 18th of August at $1.90, sold it here on the 28th of August for $4. That's a nice gain, 110% gain in 10 days. Here was a bullish setup I took in XLK. So I've just come out of my NASDAQ bearish setup. 2 days later, I'm going into a bullish setup in XLK because I'd identified a market turn. And this was in 4 days, made a 90% gain buying a call debit spread in XLK. So if you'd like to learn more about combining trend following and counter trading techniques, I am hosting a live online workshop next Thursday, September the 22nd at 8 a.m. Eastern. The name of this workshop is How to Make Money During an Inflationary Recession. We're going to be covering where do I put my money when stocks, bonds, gold and crypto all keep falling at the same time. We'll be talking about what is stagflation and why understanding its implications is so important for your financial well-being, and also share with you my headlight theory of capital allocation and how you can illuminate the path ahead. So join me next Thursday in a week's time, September the 22nd. It's at 8 a.m. Eastern, so it won't clash with the Candlestick Forum. To learn more, just head along to www.toweroftrading.com/stagflation-cf. The workshop is 100% free and it's live, so you get plenty of time to ask me lots of questions at the end. Really look forward to seeing you next Thursday, and I'm really happy to answer quickly any questions you may have right now. So the real crux of what we'll be covering next week is that combination of trend following and counter trend trading, how we do it, and more importantly, why we do it, and why I think it's such a powerful combination, particularly for the market environment that we're in at the moment. All right, let me just catch up with any questions. WB is asking, what was the name of the book? The name of the book is also the Tao of Trading. The name of that book was inspired by Bruce Lee's book, The Tao of Jeet Kune Do. In addition to being a trader, I'm also a Jeet Kune Do instructor. So martial arts have been a big part of my life for a large period of my life. And Bruce Lee has certainly been an inspiration and a mentor to me. So the title of my book is a tribute to Bruce Lee, in effect. You're welcome, Michelle. Mike, my rule of thumb for using 3 ATRs, so if you look at I regard the 21 EMA as like the mean. There's 21 days in a month, and you'll find stocks tend to revert to that mean if they get too extended away from it. So if we're more than 3 ATRs above or below, that's usually a really bad time to be getting long if 3 ATRs above, or getting short if price is 3 ATRs below, because usually the stock is a reversion to the mean becomes imminent. And we'll be talking more about that next Thursday as well. Magic Momo Superdog, you're asking, do I have any data on the success of my methods? Yeah, look, I mean, I usually run a 65% win rate with a risk reward of about 2.1 to 1. And my most successful student last year made a 717% return on his portfolio. Zukowski, you're asking, how do you spot market counter trend? What are the signals? You'll have to come along next week to find out. It's going to take a little bit of time to explain. Bill, you're coming along? Awesome. Look forward to seeing you. Leslie, yeah, I tend to reduce position size in all trades in this environment just because things turn around a lot more quickly. So I think it makes sense to reduce your risk budget on each trade. The workshop next week will go for about 90 minutes, Mike, including Q&A. But yeah, the workshop will be recorded. We'll send a link to everyone who registers. SP, you're asking, do I mostly trade index ETFs? I wouldn't say mostly. I mean, I definitely trade ETFs. I often use them as examples because people tend to be very familiar with them, but I trade single stocks a lot as well. David, I don't day trade at all. I just don't find day trading is really conducive to my personality or my lifestyle. I'm a swing trader, so I base 95% of my trades on daily charts and do all my trading and analysis at end of day. Yeah, David, I mean, day trading, I don't want to invalidate day trading. If it suits your personality, go for it. I just don't enjoy it. I like having time to plan my trades. I like to plan my trades when the market's closed. Keeps me in a very emotionally calm state. Trying to make decisions when the market's flashing red and green. I just don't enjoy it. Ozakowski, I don't look at fundamentals, to be honest with you, in my trading decisions. I'm a purely technical trader. In fact, JP Morgan, I mean, they did some research a few months ago and they found that if you look at stock returns within a 12-month period, the correlation to valuation is only 6%. In other words, 94% of a stock price's movement on any time frame of 12 months or less can be explained by things other than valuation. So I think if you're a trader and your time frame is 12 months or less, looking at fundamentals is really a waste of time. Awesome, David. I'll see you next week. Kathy, you're asking, do I have any favorite sectors for longs currently? Look, pretty much every sector is in a downtrend, with the exception of the energy sector. I think energy would be one. Arguably utilities, but I don't tend to trade utility stocks because they tend to be pretty low beta. I like stocks that move around a little bit more. Yeah, but I'm not really focusing on long positions just at the moment. Not with quad witching today, tomorrow, today my time, tomorrow your time, and we've got obviously Fed meeting next week. Next week's will be the most anticipated Fed meeting since the last Fed meeting. Gary, yeah, I do use the VIX, and sometimes I even trade the VIX. Very welcome, Chris. Walter, yeah, I do trade ETFs. I trade ETFs quite a lot. I would say ETFs would account for maybe 30%, maybe even as much as 40% of my trading. I like ETFs because they're liquid, but I do trade single stocks as well. Awesome, SP. Look forward to seeing you next Thursday. Yeah, Steve E is just pointing out, if you're having trouble registering, just copy and paste the link into Chrome. Yeah, you might just have to copy and paste it or type it out. Phil, you're asking, are there currently any advantages to be had in non-US markets? As you can tell by my accent, probably I'm Australian, and I used to trade the US market and the Aussie market. It's just home market bias at work. But I stopped trading the Australian market a few years ago, simply because trading 2 time zones was tricky. It just added stress. And the fact is the US equity market is by far the biggest and the most liquid and has by far the most abundant opportunity set. So that is what I focus on as an Australian living in Singapore. All right. So I think you guys are really lucky. You've got an amazing equity market, and I think that's probably all you need to focus on. Jimmy, I would not endorse my system for day trading because I don't do it. I'm a swing trader. So if day trading is your thing, you know, it's probably not going to suit you, to be honest. It may work, but I certainly wouldn't endorse it for that. Gary says, yeah, like using a screwdriver to put in nails. Yeah, something like that. Mike, you're asking, do I have an average time that I hold trades? Yeah, good question. The average time, it's probably shorter this year than it was, you know, most of the preceding years. I would say my average holding time is anywhere from 2 to 3 days to 2 to 3 weeks. That would be about the sweet spot. Awesome, Kevin. See you next week. Thanks, Stephen.
All right, Simon, thank you very much.
It's been an absolute pleasure. Thanks, Steve. And I was just going to say, if you know candlesticks, that is only going to supercharge what I teach anyway.
All right, well, good. All right, everybody. Simon, thank you again. Remember, it's
my pleasure.
Oh, it's 9 o'clock in the morning over there. So we appreciate you coming on. Everybody, take a look at it. Again, very, very good perspectives. All right. Thank you, Simon. And thank you, everybody, for